सम्पूर्ण विद्यार्थी भाइ बहिनीहरूलाई आजको यो कक्षामा म स्वागत गर्न चाहन्छु। Heartily welcome to all my dear students in today's class, and today we are going to learn about macroeconomics. What is macroeconomics and what are the macroeconomic variables? Macroeconomics deals not with individual quantities but with aggregate of these quantities, not with individual incomes but with national income, not with individual prices but with price level, not with individual output but with national output. Macroeconomic variables. Macroeconomic variables are the indicators that show or indicate the current trend and situation of the economy and help understand, analyze, and predict the performance of an economy. In macroeconomics, we should understand some key points. Macroeconomics, it is the briefest description, is the study of the economics, total output, employment, and the price level. And in macroeconomics, mostly we study about aggregate factors of economy. And in macroeconomic variables, we read some economic terms that is mentioned here. Real interest rate. Interest rate adjusted for inflation is known as real interest rate. In the time of inflation, there is low purchasing power of money. Due to the low purchasing power of money, the market price becomes ups and downs during the period of inflation. Unemployment. Unemployment is the situation where people are willing and able to work, but they are not able to find any work. Such condition is known as unemployment. The people are seeking to job, but they are not getting to do job, and they are not actually connected with job. That is known as unemployment. And one type of unemployment is frictional unemployment. Unemployment caused by the search for a new job or a transition between job. If a person lose one job, and if he leave one job and if we are going to he is going to search another job, and the time period between these two jobs is known as frictional unemployment. Business fluctuation. Fluctuation in the level of income, employment, general price level. Structural unemployment. It is caused by a mismatch between the job available and the skill level of unemployed. Structural unemployment means the unemployment which is created by the situation or by the condition of government. Now, distribution. Study about how the comparative shares of the different factors of production are distributed out of the national income. Distribution is the most important part of the study of economics, and generally distribution helps to distribute the income of different factors of production. Now, another things is here is we are going to talk about what is another key terms, that is social security contribution. Social security contribution. Social security contribution made by the employers and employees based on a percentage of salary to support the social security program designed for retirees. In social security contribution, the employment provider organization made a plan to keep certain amount of money of employed person, and after the completion or after the end of its job, the uh, employed employer should provide the uh, facility to its employee, and it is known as social security contribution. Now change in stock. Closing stock minus opening stock is known as change in stock in economy. Capital account. It includes the transactions related to the buying and selling of real assets of financial assets between the business, firms, and citizens of two or more countries. Exports. Exports means goods and services sold outside the country or to the foreigners. If we sold our goods to foreign people or foreign country, it is known as exports. In the time of export, we gains foreign currency. Import. Goods and services purchased from outside the country is known as import. And in case of import, we have to pay the money for foreigner, so we should not take more import. And export increases the level of income, and import decreases our remittance or our uh, foreign reserves. Then final goods and services which are ready for consume. By the use of all raw materials, we can make the final goods and services, and final goods and services are that services which are ready for consume. Then transfer payment. All types of payment received without rendering any service. Yes. And that payment between the two countries due to the foreign exchange, due to the international trade, due to the foreign employee payment, etc., is known as transfer payment. Then another things is here, undistributed profit. Undistributed profit means a part of profit that is not distributed to the shareholders. A part of profit which is not distributed to the shareholder is known as undistributed profit. It is the profit which is made by the manager of any organization. Now, depreciation. Another key terms of microeconomics is depreciation. Depreciation means value of capital that wears out value of each and every goods decreases its value year by year. It is known as depreciation. Then investment. Expenditure made on purchase of new machines and equipments. It is investment. Investment is the factor, or investment is the one of the factor to make the real output. And investment is known as input, and it gives the result as a output. Market prices. Prices at which goods and services are sold and purchased in the market, it is called market prices. Market prices means the current price of goods and services in the market. Factor cost. Factor cost, the expenditure made in factors of production, is known as factor cost. Inflation. A rise in general price level, that means Decreasing of purchasing power of money is known as inflation in economics. Intermediate goods. Goods and services which are used as inputs to produce other goods is known as intermediate goods. Intermediate goods means these goods are especially used to produce final goods. Suppose we are going to produce rice or beaten rice. In that time we need paddy crops. Paddy is the intermediate goods to change into rice. Then another term is here, net export. Net export means exports minus input. Exports minus imports. Exports means the things which are bringing from the other nation is export, and import means the things which we are sending from this country is import. And the difference between export and import is known as net export. Net indirect tax. Indirect taxes minus subsidies is known as net indirect tax. Double counting, including some product in the national twice or more, that is double counting. Double counting means sometimes we count paddy crops as a GDP of country, and paddy crops change into the rice from the rice mill, and that also counted. That means two times count the same things. And another example, if you count the mustard seeds as a national income as GDP, and again if you count the price of oil which is made by the same mustard, in such case we have to see there is double counting. Okay, now capital gains. Income received from the transaction of financial instruments is known as capital gains. And these are the some of the terms which are used in macroeconomics. Now we are going to introduce some of the macroeconomic variables which are mostly connected with macroeconomics. One, gross domestic product, GDP. Second, balance of payment. Third, inflation. Four, interest rate. Five, exchange rate. Six, economic growth. Seven, unemployment. Eight, money supply. And what is gross domestic product, GDP? GDP is the market value of all the final goods and services produced within a country in a given period of time. And especially, GDP denotes that the production of a country in a year. Then, number two, balance of payment. The balance of payment, BOP, is also known as balance of international payment. It is a statement that summarizes all the transactions of countries, individuals, companies, and government bodies with individuals, companies, and government bodies outside the country. So, balance of payment means the transaction between two countries for goods and services which are visible or invisible. All types of all types of transferring remittance from one country to another country is known as balance of payment. Now, inflation. Inflation, it is the rise in general price level of goods and services. It is measured as the rate of change in price of the basket goods. If we are going to purchase some goods from the market, if we have to pay more than previous day, that is called inflation. That means purchasing power of money is going down day by day. it is the cause of inflation, or it is the situation of inflation. Now, interest rate. It is also the price paid for the borrowing money and return received for lending money. There are two parties. One party needs money and another party wants to invest that money in interest. So they determine the interest rate. Interest rate mostly determined by the demand for money and supply of money. The intersecting point between demand for money and supply of money determine the interest rate. Then exchange rate. Exchange rate is the rate at which the currency of one country is exchanged with the currency of another country. We need international currency for transferring goods one country to another good, or for importing and exporting goods from one nation to another nation. So in that time we need exchange, or we need foreign currency, because in our domestic currency does not work in the foreign nation. Due to that, we should need, or we have to change the money of, and we should convert the money in foreign currency. It is mostly determined by the policy of central bank, and it is called exchange rate. It determines the rate, that is called exchange rate. Now, six, economic growth. Economic growth is defined as the increases in the economic's output over time. It is the increases in goods and services produced by an economy or nation for a specific period of time. The most common indicator for measuring the economic growth is real gross domestic product, GDP. And GDP is the indicator of economic growth. And if the level of GDP is higher, it gives the self-dependency of nation, and if we are able to increase the GDP, it also increase the per capita income of people. So GDP is one of the most important factor of measuring national income. Then next, unemployment. Unemployment is the situation where people are willing and able to work, but they are not able to find any work. What does it mean? Unemployment. Unemployment means such situation where people are seeking job and the people has the quality or skill capability for that work, but they are not getting any chances to do work. It is called unemployment. Then money supply. Money supply. Supply of money is only that part of total stock of money which is held by the public at a particular point of time. It includes coins, currency held by the public, and demand deposit of commercial bank. Money supply. Money supply also determined by the circulation of money, and if there is the higher circulation of money, it creates the uh, in situation of inflation. So mainly commercial banks determine the interest rate to maintain the situation of flow of money in market. So in this topic we read some of the macroeconomic variables, and these variables are the uh, main variables of macroeconomics. Thank you. Saying this much, I want to stop this today's class. Thank you, and try to learn more and more. Have a nice day.